glad to have with me right now Fran Rodilosso, head of fixed income ETF portfolio management over at Van Eck. Thank you for being here. What we're seeing, we did see the market sort of quickly sell off and make its way back. There has been talk about, moving towards the 2%, but that in fact inflation remains somewhat elevated. They also talk about the labor market conditions remaining solid, and that's different. The reference point is different because they had said in the prior that conditions have eased. So they are making some changes when it comes to the labor comment.
Yeah, it seems as if even with the first 100 basis points of easing we saw in the 3 meetings last year, those were somewhat hawkish cuts, at least relative to market expectations. And it seems the Fed wants to somehow, look, I think 100% expectation that they were going to be on pause today, but added a little more hawkishness into that pause. No one thinks they're about to hike, but I also think this leaves them flexibility for maybe more dovish language if they need in future meetings as well. But very cautious. What we were also looking for is maybe some kind of comment on quantitative tightening, whether or not they were going to put that off until March, like whether they might start reducing the roll-offs, but that was not accelerated. So again, I think they're leaving themselves a lot of flexibility, and probably justifiably, because as we see today, more volatility is probably likely to come out of the White House than out of the Fed, and they may need to be prepared to react to rapidly changing conditions.
They did say the Fed is attentive to risks to both sides of its dual mandate, the balance sheet runoff to continue at the previous pace. That's your point on that, so they'll keep rolling that off. The vote in favor of the policy was unanimous, so no one said, hey, let's cut today or make any other moves today than the one we're presenting. Economic activity has continued to expand at a solid pace. Things are looking pretty good. I guess they don't want to mess with the recipe at this moment. There was a time when they cut, they were concerned about the labor market. And even in the last round, they talked about a labor market easing. In this round, talking about it being solid. Labor market doesn't seem to be a worry, but at the same time, what about if there's deportations? What about the immigration?
Yeah, I mean, this may leave, again, the Fed's leaving themselves room, maybe, if there should be increased tightness in the labor market. I mean, this will take a while to play out. I mean, I think the higher deportation numbers that we're looking at are probably over a several-year period, although the net effect will definitely start being felt straight away, and fewer people coming into the country at the same time. So again, I think that's cause for maybe not being quite as constructive on the labor market easing, given that uncertainty. I think that the key factor here is, as you said, we've been doing well. I mean, growth expectations have been met or exceeded consistently, really throughout the Fed hiking cycle and the early parts of the less aggressive Fed easing cycle. And that is why, we've seen yield curve normalization, I think more so than necessarily major inflation worries or even quite yet, although we think there will be, we will be paying for concerns about U.S. debt fundamentals at some point. Basically, the market is still pretty optimistic on growth, and so is the Fed.
At the same time, you had the Trump administration rescind the freeze on federal programs. I mean, it was my understanding they were really just looking at certain programs, and people started to take it very broad-based, and that was not what they meant. They didn't mean food stamps, they didn't mean Medicare and things like that. So I guess rescinding that, but it could mean you have federal workers that are going to be unemployed if they get tight on that. That could contribute, and that could be part of the dual mandate that they said that they are, attentive to the risks on both.
I think one way or another, there'll be a reduction in the federal workforce. So, rescinding this particular freeze or not, I mean, they've already started eliminating some offices and, this, call it a buyout or 8-month work from home plan. They have the offer they had extended yesterday. So, yeah, I mean, that could provide some relief, I suppose, to the labor situation. But I think the problem with the freeze is more likely just the lack of detail. And so if certain, offices that would facilitate payments weren't able to operate, whether or not the exact programs were cut off. It was just a lack of clarity. Maybe we'll see this return with more clarity at some point in the near future.
So in the meantime, the 10-year bond yield, folks, is at 4.58% right now. So the yield just ticked a little bit higher than where it was at 2 o'clock at 4.56. What are you telling folks for investing these days? I know you have a few ETFs that you could tell us about here. What are maybe some good ideas for folks for 2025, especially since now we've gotten in this breaking news?
Yeah, we've been sticking with what's been working in terms of our discussions with our clients, and we have promoted the notion of higher for longer, which, the 100 basis points of cuts notwithstanding, I think versus expectations, we are higher for longer. We thought last year that we would see a curve steepening should the Fed start cutting, and we think that continues.
Right.
And so that means, floating rate securities staying closer to the front end, taking some moderate credit risk, more in the investment grade space, are good ways still to earn attractive yield. So investment grade floating rate notes above 5% yield, not going down into the loan market or high yield market, and still getting 100 basis points over Fed funds or cash. Or we talked. I've mentioned to you our collateralized loan obligation ETFs. There are a lot of those in the market today. We have an interesting one that covers the whole investment grade universe in that space. That's yields closer to 6% in terms of like the 30-day SEC yield on our CLOI
yeah, that's
ETF.
CLOI.
Yeah, so that,
and the other one was FLTR.
FLTR
right?
is the investment grade floating rate note.
Yeah.
I mean, these are just things we like. They're up in quality versus similarly yielding options out there in the market. And they're virtually no interest rate duration. And while with all the uncertainty out there, duration can be an opportunity, but it's also a risk. We don't see a need to rush out the curve just yet.
You also have CLOB.
We do. That is in the mezzanine space in CLO, so it doesn't invest in the AAA collateralized loan obligations, but still high quality, AA down to BB. So it's a yieldier option, closer to 7% current, SEC yield than 6% for a CLOI. But should credit spreads start moving wider significantly, the higher up in quality is where investors will probably want to be.
You also said it's not likely to see short rates go significantly lower without seeing probably a recession of risk or some other significant event.
Yeah, we don't see
right.
We don't see the Fed going to aggressive cuts unless credit spreads are a lot wider.
Good to see you, Fran. Thank you so much for being here and telling us about some of the funds and, of course, handling the breaking news here. And that's Fran Rodilosso of Van Eck. Thank you very much for being here.